always think it's worth standing back and try to put in perspective what's going on in markets, and I've put in a couple of charts here which I think are important to remember. The one on the right, as we're no doubt all aware, is that the share of passive in equity markets globally continues to rise, and that manifests itself in the chart on the left in showing that the actual volume of transactions that are setting the prices that we rely on in listed equity markets tends to be falling relative to market cap. So less and less volume is setting prices. When that happens, that is sort of why you get more volatility. And the reason I'd caution against that is volatility is a hopeless measure of risk. The risk in these underlying companies is not changing. It's just that the share prices are moving around a lot more. That's scaring people. And interestingly, as computers tend to be more of the volume, I think it worries me how many fundamental investors look at those reactions and then assimilate that behaviour such that they almost lose sight of fundamentals and become momentum investors themselves. And I think that's one of the more dangerous trends in equity markets. But to go back to your question on valuations, tech was undoubtedly the most surprising thing to come out of August for me. The scale of the reactions to what were, in most cases, very small earnings surprises were ludicrous. Wisetech Global was probably the poster child, but again, to put some numbers around that, and you can see it on this chart here, the revenue was up sort of 250 million or so in the past year. The earnings went from sort of 300 million to 380 million, albeit there are a fair few acquisitions in that, and the capitalised R&D was $60 million higher than last year. So you look at all of that and say, it doesn't seem like that much. The market cap went up more than $9 billion. $9 billion is larger than most of the companies in Australia, let alone as a price move. And Wisetech's market cap, as you can see there at 40 billion plus, is not a mile away from something like Telstra, and Telstra had a solid result and reported EBIT of a bit over $3 billion, which, as you can see there, is about 3 times Wisetech's revenue, let alone their profit. So the PE multiples there, to me, are pretty crazy, but I think we all know that that's the epicenter of speculative activity around the world, the Nvidias of the world in the US. That's where prices can move most, and people are attracted to prices that move most because they love a fast buck. So when it comes to valuations, there's a lot of crazy stuff happening. I'd probably summarise it in this chart here and just highlight that a lot, and you look at the chart on the right here and you'd probably say, well, the vast bulk of the market is not at crazy multiples, albeit that I think it's very difficult to argue that anywhere looks cheap relative to interest rates. So market prices and asset values across property equity markets remain pretty expensive versus history, but if you dig below the surface, most of the drivers to that markets being expensive is really driven by a couple of very highly priced sectors, and IT, as I just highlighted on the previous chart, remains the main one. So if you're happy to look elsewhere, Justin touched on things like resources, material stocks, energy, they're at very normal multiples. Often the conditions in our view are getting to more the depressed end of normal rather than elevated. So you're getting a combination of relatively cheap valuations and fundamentals that we'd look at it and saying more likely to improve rather than deteriorate. But certainly the summary of where market prices are and around the world on the left did say the ASX is probably skewing a little bit more expensive versus markets globally, but if you were to encapsulate that, the one thing that you would say is that everyone loves growth everywhere. So the reason US markets are more expensive than Europe by a lot is that Europe doesn't have much growth. People are running to where the growth is. Markets like India, very expensive because it's growing. Mention growth, investors get excited. Valuation's not much more complicated than that at the moment.